Tech stocks are getting hammered today. Qualcomm just dropped over 5% in a single session, and the Nasdaq is feeling the pain across the board. But here's the thing. Some of the biggest names in healthcare and retail are absolutely crushing it right now. So what's really going on under the surface? Let's find out what it means for your portfolio. Let's start with the indices. So the Nasdaq had a rough day, and honestly, it's the worst part of a rough week. We're down 0.97% right now, sitting at 25,678. But that's on top of a weekly decline of 5.22%, and that tells you something bigger is happening in tech and growth stocks. You're seeing selling pressure across semiconductors, across software, across a lot of the names that have been carrying the market. It feels like people are reassessing some valuations, or maybe they're worried about slowing demand. Either way, it's not a great day for the tech crowd. Now here's where it gets interesting. The Dow Jones actually managed to go slightly positive today, up just 0.17%, sitting at 50,872. But, and this is important, it's still down 0.85% for the week. So the Dow is way more resilient than the Nasdaq right now. That's actually a signal that people are rotating out of growth and into more defensive, value-oriented stocks. You've got industrials, healthcare, consumer staples holding up better. So while the Nasdaq is struggling, the Dow is basically saying, we're okay. We're just being more careful about where we're putting our money. Now here are the top movers of the day. Let's talk about Qualcomm. And yeah, this one stings. Down 5.67% today at $205.42. And for the week, it's down 14.39%. That's a massive weekly decline. Qualcomm is a chip maker, so it's right in the middle of the semiconductor sell-off, and it's getting hit by concerns about PC demand, smartphone demand, maybe AI spending being repriced. When investors get scared about tech, chips get hit first and hardest. This is a name a lot of people own, so if you're holding it, today's probably been uncomfortable. Now flip the script and look at Thermo Fisher Scientific, up 5.2% today at $494.07. And it's up 2.49% for the week. This is a life sciences and diagnostics company. And here's the pattern. When growth stocks sell off, healthcare and defensive businesses tend to hold up or move higher. Thermo Fisher is benefiting from that exact rotation. People are pulling money out of flashy tech names and moving it into companies with steady, predictable earnings. That's a classic defensive move, and Thermo Fisher is a textbook beneficiary. Lowe's is up 4.52% today at $217.37, and it's been up 5.19% for the week. That's interesting because Lowe's is a home improvement retailer, so you'd normally expect it to be sensitive to economic growth. But here's what's happening. People are rotating into consumer staples and discretionary names that have actual earnings and dividends away from speculative growth. Lowe's has solid fundamentals, a decent dividend, and it benefits from home improvement spending that's pretty resilient. It's not flashy, but it's working right now. Zoetis is up 4.29% today at $82.20, and it's been up 7.61% for the week. Zoetis makes pharmaceuticals and diagnostics for pets and livestock, so it's a healthcare play with very steady demand. Pets still need medicine and care even when the economy is uncertain. This is another classic defensive rotation. People want predictable earnings. They want businesses that aren't tied to the economic cycle, and Zoetis fits that perfectly. Pet healthcare is almost recession-proof. And Stryker, up 4.14% today at $314.01, and it's been up 7.06% for the week. Stryker makes orthopedic devices, surgical instruments, hospital equipment. It's a medical device company. Same story as the other big winners today. Steady, predictable cash flows, resilient to economic cycles, and it pays a dividend. When a market gets nervous, Stryker doesn't care. Hospitals still buy their products. Surgeries still happen. That's why you're seeing it rally while tech is selling off. Now let us look at energy and fuel. Oil slipped a bit today, down 2.04%, and it's trading at $89.44 a barrel. For the week, it's down 4.61%, which is a meaningful pullback. The main story here is probably demand concerns, if tech is slowing and companies are worried about the economy, they use less energy. You're also not seeing any major supply disruptions or OPEC surprises right now, so there's no floor under the price. Basically, oil is following the broader market mood, and today, the mood is cautious. Natural gas had a tiny move today, down just 0.32% at $3.14. Weekly, we're down 0.95%, so it's pretty steady. This is summer now, demand for heating is gone, storage is building up, and unless we get a surprise heat wave, there's not a lot of bullish catalysts. Natural gas tends to move on weather and seasonal factors more than the broader market, so it's kind of doing its own thing right now. Boring but stable. Moving on to metals. Gold is doing what gold does when people get a little nervous, down 1.39% today at $4,275.80. For the week, it's down 4.75%, which is actually more than you'd expect. Normally when stocks are selling off, gold goes up. It's the safe haven trade. But today and this week, the dollar is actually stronger, and that's working against gold. When the dollar strengthens, gold becomes more expensive for international buyers, so the demand dries up a bit. It's a classic risk-off move, but not the way you'd usually see it play out. Silver got crushed today, down 4.53%, and it's having a rough week, down 13.25%. That is way worse than gold. Here's the thing about silver, it's not just a precious metal, it's also an industrial metal. So when people are worried about economic growth and manufacturing demand, silver sells off harder than gold does. Silver underperformed gold by a huge margin this week, which tells you the market is really worried about industrial demand and economic slowdown. That's a more bearish signal than just a safe haven bid in gold. And finally, let us look at tomorrow. So here's what we're watching for tomorrow. The EIA is releasing its weekly petroleum status report. That's the oil inventory data, so crude might get another little nudge based on that. But honestly, the bigger picture is watching whether this rotation out of tech and into defensive healthcare and consumer names continues. If you hold growth stocks, you're probably feeling the pain right now, but this kind of rotation happens. Money doesn't disappear, it just moves. Today showed us that there's a lot of demand for stable, profitable companies. That's not a bad thing. It's just the market doing what it does best, finding value wherever it can. Keep an eye on the Nasdaq tomorrow to see if we get any bounce, but for now, stay calm and watch the bigger picture. For your daily market update video, don't forget to hit that subscribe button and turn on the notification.